Welcome to Stocks in Translation. I am your host, Jared Blickery, and today the voice of the people is out among the people. So we have none other than Yahoo Finance senior reporter Ali Canal. Alexander, thank you for joining us here today.
Thanks for having me.
And before we all tune in here and jump into the melee, make sure to like, comment, and subscribe on Stocks in Translation on Spotify, Apple Music, YouTube, wherever you get the podcast. And today, you might have seen her out of the corner of your eye. We are welcoming a very special guest back, Callie Cox, and she is a strategist at Ritholtz Wealth Management, and kind of a new arrival. You had just arrived at Ritholtz the last time you were here, and we're going to talk about a bunch of things in the market today. Our word of the day is resiliency. We've seen a lot of it in the U.S. economy. This episode brought to you by the number 3, and 3% is how much investors believe the U.S. economy grew in the third quarter. We're going to find out just how close they are next week, but the discussion today is going to center around why expectations matter so much. And Callie, so here's your chance to shine. We want to get your take on the market here. Even the Nasdaq's almost back at record highs. So how are you seeing things right now?
Well, it's been a pretty smooth ride this October, which is not something I expected at the beginning of the year. And it's kind of nice. Like the quiet is nice. I'll take it because there's a lot of noise out there. But at the same time, I feel like when it gets this quiet, everybody's asking, what's the next shoe that'll drop? And with an election 2 weeks away, I mean, a lot of people are pointing to that and saying, well, that could topple markets. Looking at what the Fed is doing, that could topple markets as well. So I'm enjoying the quiet. I love seeing prices go up, but I'm trying to dig to what's happening underneath.
You know what? I would describe markets as resilient. And guess what? Our word of the day is resiliency. So let's define that real quick, and then we'll get into it. Resiliency refers to the capacity to endure and quickly recover from challenges, such as an economic downturn or a financial crisis, all the while maintaining stability. And this is something you've written a lot about, the labor market stability here, and just in general, what do you think accounts for all of this?
The job market, bar none. I mean, the job market was incredibly strong in 2022, 2023. That's a blanket statement. Of course, it hasn't been as strong in some sectors as it has in others. But the fact that unemployment has been so low, wage gains have been so strong, even as inflation has come under control, everything's just become more affordable, and we've all stayed employed during the process. That is a rarity in history. Usually the Fed topples over the apple cart somehow and either breaks the job market or, lets inflation run wild. That hasn't happened this time. And when you consider that, consumer spending is 70% of the U.S. economy, and people are making money, then it shouldn't surprise you that the economy has been so resilient.
What do you attribute the strength and resiliency of the job market to? Is it because of this post-pandemic era that we're in, that people did a bunch of hiring and then now folks are unwilling to lay off those people again? What do you think is a catalyst for that strength?
Well, Ali, I think that's part of it. So what we've seen really since the pandemic started has been these huge fluctuations in demand and problems with the supply chain. So companies haven't had a good chance of forecasting how many people they've needed, but we had huge demand in 2021, 2022. I mean, you saw a ton of spending across the tape, maybe more on experiences than TVs or cars or furniture. But people were spending a lot of money, and companies have to hire to get back up with that demand, to meet that demand. I wouldn't classify the job market as solid right now. I think it's okay.
Where are the cracks? Because that's where I'm interested in. And I know labor is kind of a lagging indicator, but we want to look at these things so we can hopefully not be too surprised.
Right. And you're right. Labor is a lagging indicator, but there are some leading indicators you can look at. Initial claims for unemployment. The first time somebody goes into the Social Security office and says, I'm out of work, can I gather unemployment? That's a leader, and I think you can understand why.
Sure.
And we've seen that stay low, especially compared to how big the entire workforce is. But there's this interesting dynamic going on where there aren't a lot of layoffs. It seems like people are keeping their jobs, but companies aren't really hiring either, which is a problem if you're looking for a job because there aren't many roles out there. And that's usually the first step toward bigger things happening in the labor market. I'm not saying that's going to happen, but that's been a bit of a yellow flag for me.
Well, okay. So look, we're talking about the labor market. The flip side of the Fed's dual mandate is inflation. And we've seen inflation come down. Even the headline number, which has been stubborn. We've seen rent inflation, which is computed in various ways. That's kind of finally eased and is not the big orange or red warning flag that it was. So what do you think about the inflation side here?
Yeah, well, you're right. The Fed has two jobs. It's to keep people gainfully employed and to keep prices in check. And that means prices are going to grow, but hopefully our paychecks grow with them so things remain affordable, affordable.
Yeah.
And I think that's something that people forget a lot. The fact that inflation doesn't heal itself through lower prices. It's actually higher prices that become more affordable as you examine your budget.
On that right there. That's really interesting because sometimes I've heard this phrased another way. The cure for higher prices is higher prices. They just kind of stay that way. And people don't necessarily want to hear that because it means things are less affordable. But the flip side is you kind of get shortages, and that's where it gets back to supply and demand there. I don't know if you have any thoughts on that.
Oh, I have so many thoughts, and I love sharing this with friends and family because I think it encapsulates what's going on so well. If you're getting deflation, if you're seeing prices fall, that is not a good thing. That means that there's something nefarious happening in the economy, and chances are there's going to be massive job loss around the corner. Item by item, it's a little bit different. Like if you see your favorite,
Your old iPad might get a little cheaper.
Your old iPad might get a little cheaper. Your Caesar salad at the deli might get a little cheaper, but I'm talking across the economy. If you see prices fall, then that's indicative of demand coming down. Exactly. But where we're at right now is that prices are growing. It shows that the economy is healthy. People are still spending, but wages are growing at a 3 to 4% pace. And your paycheck might not be going up 3 to 4%, but there are, signs that paychecks could be catching up. And eventually that means you go to the grocery store and maybe you're spending, $160, but your hourly earnings mean that you're,
on half
working,
a bag.
Exactly, working a little bit less to afford that $150.
And we often talk a lot about the unemployment rate as sort of this key metric to watch. It feels like wage growth is becoming a more important metric to keep your eye on, especially as we continue to get jobs reports in the quarters to come as we compare them to inflation as well.
Yeah, well, if you want to watch for signs of inflation from the job market, and you should, wages are a huge cost for businesses, then you need to watch wage gains, particularly across sectors too, because a lot of the wage gains have been happening in more services-oriented sectors, hospitality sectors. So, I'm going to get the complaint that, my paycheck hasn't gone up in X amount of months, and I get it. It's an uneven job market. But yeah, if you want to watch wage pressures, then what you need to look at is average hourly earnings.
The hospitality sector, you're saying, so far has been the leading of the gains that we've been seeing in wages?
Yeah, and quite frankly, I haven't looked at wage gains by sector in the past few months, so that might have changed. But for most of this expansion, that's been the case.
Allie, one of the things I was thinking about when I was reading your notes, and this stood out to me, is that we are in the middle of a weird bull market. Yeah. And we just had the 2-year anniversary of it, so that basically means we're 2 years off the low. But one of the things that I've noticed that happens in year one of a bull market, didn't happen this time, is small caps tend to lead. Didn't happen this time, threw me for a loop. There's a lot of other stuff because we are also starting this in a rate hiking cycle. That has effects too. So just talk to us about maybe some of the conversations you're having with clients. Like, it's not always the same as history, but it kind of rhymes here.
Yeah, you're right, Jared. It is a weird bull market. I'm scratching my head too. I mean, when we got into this, and I guess that was in October of 2022, I was like, there we go. Small caps are going to lead us to the races because the economy it can't get much worse from here, but that didn't happen. And that was a product of the rate environment.
Yeah, rates.
Yeah, and that goes to what you said about rate hikes. I mean, out of all the bull markets we've seen since 1950, except for one, they've started with Fed rate cuts. The Fed saying, okay, we're going to
or at least on pause or something. But
going
the opposite direction is kind of an outlier.
Or pointing toward easier policy ahead. Yeah. And interest rates affect how we think about money, whether you realize it or not. So typically when rates come down, you're a little less inclined to save money. You're a little more excited to, maybe spend that money you have. And the Fed knows this. This is why interest rates are a tool. But you're right. Small caps have been hammered this bull market. I mean, they're just now not plumbing, but they're just now,
trying to break out, but it's been,
trying to reach those highs again.
Market rotation starting to show itself a little bit in small caps.
Good point. So maybe you can talk to us about rotation that we've seen in the market too, because it's not just all the Mag 7.
Utilities.
Not anymore.
Yeah.
Utilities, AI play.
AI play, yeah, but also a rate-sensitive play too, which is ultra interesting. But we see this rotation as being a good thing, right? We see a lot of value in markets outside of big tech. And typically when you think about a bull market, you think about all stocks rising together. And to a certain extent, that's true, but it hasn't happened in this bull market because the Fed has almost deprived the oxygen through high interest rates. And for good reason. They were trying to get inflation down, but that's why this bull market has been so weird.
How do you determine the areas of the market that are undervalued right now? Because
And
for
there are some too, right?
because there are some. Because for some people, they might think, oh, stocks are very expensive, but you say that there's pockets where you can find.
So where are the
good
opportunities?
value.
Yeah, well, I would encourage you to look outside of tech, because when people say stocks are expensive, they're looking at the price to earnings ratio, so what you're paying for a share versus, how much that company is earning per share. They're looking at the S&P in total, and if you think about it, big tech makes up, I think, like 25 to 30% of the S&P, and big tech companies are very expensive, probably for a reason. They have some really exciting stories going on. But if you're thinking that the market is, maybe too expensive and you want to look for those value plays, you have to look at the other sectors. I mean, look at real estate, look at financials, look at some other rate-sensitive sectors. I mean, consumer discretionary looks really interesting right now as we play the, will this economy stay afloat? Will it not stay afloat? Just look at it on a sector by sector basis. Look at the price earnings ratio. Look at it on a forward basis, which means 12 months ahead, because the market is always looking ahead. And from there, you can see a lot of disparity between sectors.
Hold that thought. We got to take a really short break. Coming up, we're going to be cracking open next week's GDP estimate for the third quarter. And then we invite OG storyteller Aesop, from Aesop's Fables, onto the set for Who Wore It Better. We are back, and this episode brought to you by the number 3%. That's how much investors think the U.S. economy grew in the third quarter, and we're going to actually get the results next week from the Bureau of Economic Analysis when they are released. And this is going to be an estimate, a preliminary estimate for the third quarter gross domestic product. And I thought this would give us an opportunity to explore the relationship between investor expectations and what really happens, and also kind of break down this news release. And we'll just take one here, GDP. It's released, I believe, 3 times. So we'll get one estimate or a preliminary, and then we'll get 2 revisions to it. For instance, we just kind of closed the book on the second quarter with a little bit of surprise. It was 3% as well. And that was versus the original print of 2.8%. So tell me how you think about all this data being released, and then in the context of what investors think it might be.
Yeah, well, you called it resilient yourself. The word of the day is resilient, and the economy is incredibly resilient, surprisingly resilient. I don't know if anybody would have guessed that we'd be, running at a 3% growth rate this far into the expansion. I mean, 4 years into it. And just to give some context, the GDP growth that we saw in the 2010s was around 2%. So that's my rule of thumb.
It was anemic. I remember that back then, yeah.
Yeah, it was anemic, but 2% is about what you should expect in this environment with a job market that's
inflation goal. So
it is the Fed's inflation goal. So yeah, there is some matching up there, but it's also with the job market slowing down a little bit, little to no growth is probably gonna happen soon. I hope not.
So it's 3%. So we're expecting that the 3% doesn't last. But even in the rearview mirror, for instance, I'm going to bring up something, hopefully it's not too much of a non sequitur, but we were talking about this last time. GDP was negative 2 quarters in 2022. People said that's a technical recession. But recently, one of those quarters was revised positive. So now we know we didn't have 2 quarters of consecutive negative GDP. And so that recession theory kind of flies out the window. But that just shows you what can happen with the data. Sometimes the data changes after the fact, and then investors have to, they have to come to grips with this. So, I mean, what are your conversations like with clients when they're saying, well, reality is this way for me, but the stock market is doing this, and it's forward looking and all that. But how do you talk to them?
Yeah, well, I understand it, and it's always an interesting conversation. And I want to point out something you said about 2022 and the 2 consecutive negative GDP quarters. So that was. I get why people think it was a recession, right? The economy didn't feel good. We were all freaking out about inflation. It was a bear market. But what we saw in terms of economic growth was strong consumer spending, but then inventories and exports weighing on the GDP number, which if you ask any economist, they're going to say, there's not a lot of signal in there. There's a lot of noise.
Okay.
And that's why we saw those 2 consecutive declines in GDP. And that's probably why one of them was revised higher, because it was more of a noisy number. So when you say that the economy feels bad, when a client says to me that the economy feels awful, I'm like, I get it. I go to the grocery store too. I don't like paying higher prices. It does feel uncertain. You can feel change happening. But at the same time, our expectations are so low for what could happen. And the job market has been so strong, at least in certain areas. And then usually you get the kickback of, not for me. And you just have to remind them that we are slowly getting back to normal. So I get it, but that doesn't mean that you abandon your financial goals because things don't feel great.
And when we talk about expectation versus reality, I loved your newsletter this morning, basically about how we've gotten all these warning signs, right? That a recession is coming, all these indicators flashing red, but that hasn't necessarily materialized. And the whole point of your newsletter was that this time it's different is a loaded statement. Because sometimes it's
I like
not,
that too.
but sometimes it is, depending on the changes that we've seen over the past few decades. So how do you look at recession indicators? If they're no longer working anymore, how can we know when something is coming?
When do we worry?
Yes.
I think we want to know.
Oh, I'm asking that question too. I mean, I think right now, out of the classic recession indicators, you have to discard anything that involves manufacturing. The manufacturing sector has been in decline for about 2 years now. And clearly, things are still okay. GDP is running at a 3% growth rate, hopefully, as we'll see next week. So I think you have to be cognizant of what the recession indicator is before you point to it, actually knowing what it is showing you. Like the leading economic index, for example, a lot of the components, the underlying components of that index are manufacturing based. So of course the LAI has been screaming recession for a while. I like to go back to the job market. I feel like it's the most fundamental part of the economy because, of course, that consumer spending component is so important. So I'm watching initial jobless claims. I'm watching warn notices, those notices that companies put out when they're about to lay off a ton of workers. I'm watching hiring because usually hiring is the first step to something bigger in the labor market. You just have to go back to the job market.
All right. We want to get to today's Who Wore It Better because we are borrowing a few characters from Aesop, as in Aesop's fables. And we are pitting the grasshopper versus a squirrel. So we know winter is coming, right? The squirrel is fast at work gathering nuts and food for the winter in his 401k, doing the hard work to prepare for the future. Meanwhile, the grasshopper gallivants across the land, celebrating the record highs in stocks, but doesn't think to the future too much because times are good. The grasshopper is optimistic. So Callie, you've talked about this theme, optimism versus preparedness, and I'm thinking maybe it doesn't have to be either or. Maybe we can have the grasshopper and the squirrel.
That was beautiful, Jared, by the way.
Thank you.
Beautiful story.
I appreciate that. The story, the ending is yet to be written. Callie, that's what we have you here for.
Well, we're crossing the squirrel and the grasshopper, obviously. I mean,
zoologists should be, should they be celebrating? Yes.
Yeah. I need like a sketch pad to draw out what that animal would be.
ChatGPT. This is a joke. ChatGPT.
This is an AI
See if we
question.
can crack it up.
Jared will give us something
right there.
this episode.
A little blurb.
Yeah. But seriously, I think you have to be in both camps right now. And I know that's the most wishy-washy answer. Everybody hates it because they're like, you really can't be both. But there's a lot of gray matter in life, and finance is really bad at understanding the gray matter. So why not lean into it?
Even that up here, yeah.
Why not lean into it? I think you have to realize that there are a lot of interesting gaps in the market right now. We talked about valuation. The 10-year yield is at 4%, which is actually quite high for where the economy could be right now. So
yeah, the Fed started cutting and it started going up. I mean, that's a whole separate thing, but yes.
Yeah, that is a whole separate thing. Happy to go there. But at this moment, the stock market's hitting record highs. Just a few months ago, we thought that we were on the edge of a recession. We braced ourselves for something that never happened. So right now, this is the sigh of relief. You should be optimistic. You should be happy that the economy has been resilient. But that at the same time, if markets are saying the economy is okay and you're, a little nervous about the future, then maybe it's time to take advantage of those gaps and snatch up stocks on sale or potentially, buy those longer-term treasuries that do work so well in recessions.
I wanted to ask you, we touched on this before, some of the areas of value you might see in the market right here, right now. But structurally thinking about the markets here, I want to quote you in your notes. We are in the midst of a bear market in empathy on Wall Street. And we got a few minutes here. I thought maybe you could explain that and kind of explore that with us.
Oh, how much time do you have?
We have exactly 4 minutes, so go for it.
All right. Well, this is something near and dear to me. So yes. I grew up in this industry. I started off as a reporter. I learned from so many incredible people on Wall Street. And I think it's hard to find good quality people that understand that money is just more than numbers on a page. right now, especially in this day and age where we're just scrolling through our social media feeds and it's stat after stat after stat, no context there, no empathy, no vulnerability. I like to think of myself as an empathetic and vulnerable person. I mean, if you don't believe me, go on my Twitter, read my newsletter, sign up, Optimism Callie. But I hate that finance is missing this so crucial part of money management. And now that I'm dealing with longer term investors, I work for an RIA, I see how important it is to have that empathy and that vulnerability when you're talking through something that's so important for a client.
On all sides, I would think.
Yeah. And why not take it into other areas of Wall Street too? So that's one of my big things. I want to bring empathy and vulnerability back. And I want to say it's a strength. I think I do it pretty well.
I would underscore that. I think it's very welcome and much needed here on Wall Street.
Definitely. Yeah. And you mentioned your newsletter, Optimistic Callie. I've talked about it a few times. I love reading it. And you are pretty bullish over the long term. If you're a long-term investor, stocks normally go up. But we have these moments where, earlier this summer, we saw that jobs report, stock tanked. How do you keep up that optimistic tone in periods of pessimism, I guess I would say?
Yeah, well, I think you just said it, Allie. I mean, stocks typically go up over the long run. And I'm talking about the U.S. stock market and history. I have no idea what happens next. But there's a very strong case for investing in U.S. equities, especially right now when we seem to be the jewel of the world. But that doesn't mean that it's a straight line up. Cycles of joy and pain are like the story of life, right? You see that in the stock market as well. And if you are worried about where the economy goes next, if you are worried about the ground shifting underneath your feet, it's okay to be a little bit nervous and maybe prepare your portfolio for something bigger, a sell-off that's bigger. But over time, the one consistency in the stock market has been that prices have gone up and humans are going to human and we're going to recover from the crises every time, even though sometimes it feels tragic and hard.
Yeah.
And how do you prepare your portfolio if you are a little bit more nervous?
Well, I think
you talked about bonds too.
Yeah, I did talk about bonds. Well, that's one thing. So I think for every investor, and of course, we're talking to a range of investors right now, but if you're an accumulator, if you're in the early part of your life and you're investing for retirement, even you could benefit from, holding some longer term quality bonds, because a 30% sell-off, a 40% sell-off, which is actually quite common when recessions hit, is nothing to play with. And the pernicious part about recessions is that, yes, your stock portfolio often falls, but then there are things happening around you too. I mean, we talked about the job market. Typically, the job market breaks down. Typically there are waves of layoffs, and you want to be able to make the best decisions in the moment. So if that means picking up some bonds and guarding yourself from a 30% sell-off that is more like 20%, that could be the difference between buying back in, feeling okay, sleeping well at night, and panicking.
People are always kind of experiencing the last financial crisis in real time. They're thinking, well, this just happened, or this was my first one, so this is going to happen again. And there's a lot of recency bias that can unduly influence people, kind of bring them the wrong way when there's new factors at play. How do you deal with that with investors when we're fighting the last battle or our first one?
Well, this is where empathy is very important, because the financial crisis was a big deal. So I was in high school during the financial crisis. I was not an investor, couldn't open a brokerage account, but both my parents lost their jobs during the financial crisis. It was very real for me, and it was very real for so many households across America. And as somebody talking to clients who are very nervous right now, and for good reason, I mean, those scars are still fresh. It is so important to bring that empathy to the table and say, I understand you. Of course, the conversation's longer than this, but I understand you. Like, I know that feeling, and yet we have to think about your goals. So let's kind of find a middle ground here. Let's, think about how you can feel a little bit better if a sell-off is around the corner.
And really appreciate you stopping by here, Callie, with all your insights. Allie, thank you for joining us as well. And for everybody out there, please do make sure that you check out our other episodes of Stocks in Translation on the Yahoo Finance site and mobile app and wherever you get your podcast platforms. That's all for now. Signing off.